This is Andrew Canter, CIO of Futuregrowth Asset Management. In our experience, there is only one global capital market, and the direction of developed world interest rates, led by the United States, tends to set the tone for all markets. So I'd like to offer some comments about that. Investment markets have professional investors scratching our heads. Bitcoin hovering around $35,000, Tesla being valued at more than the top 8 auto manufacturers combined, and retail investors evidently driving asset prices in derivatives markets. And special purpose acquisition companies, SPACs, raised more than $78 billion in 2020 in the USA. That's about 50% of all the fresh IPO capital raised during the year. Now keep in mind, SPACs are essentially piles of capital desperately looking for something to invest in. This harkens back to the disastrous South Sea bubble episode of the 1720s, and the famous story of a company that went public as, and I quote, a company for the carrying out an undertaking of great advantage, but nobody to know what it is. Thus, we find ourselves as professionals debating the definitional differences between bubbles and manias. Clearly, the warning signs are flashing. Now, a million articles have been written about the recent gyrations in the likes of GameStop shares. While one wants to applaud the little guys ganging up on the big hedge funds to level the playing field, I can't help the feeling that they are rebels without a valuation case. And if that particular crowdsourced short squeeze wasn't actually a manipulated result of one hedge fund trying to gang up on another, then the future episodes certainly will be, as hedge fund managers are now trying to manipulate retail investors to do their bidding. Arguably, it's a new investment era with new rules. Markets may be playing out a debate between the baby boomers versus the millennials and Gen Zers. But the history of finance is littered with repeating mistakes. As James Grant has said, science is a discipline that builds cumulatively. Previous knowledge isn't forgotten or cast aside, it is built upon. But finance isn't like that. End quote. In short, markets repeat the mistakes of our fathers and grandfathers. Again, I refer back to the great bubble of the 1720s and what we're seeing again today. I'm going to bet on the baby boomers winning this debate. Interest rates have been manipulated downward by global central banks in response to the COVID crisis, and this has driven asset rallies, even in the face of economic decline and dislocation as well as ballooning debt. I tend to believe the thesis that equities have been, at least partially, if not mostly, driven upward by the low cash and bond yields. Now, equities have always had exposure to interest rates through the discounting mechanism. But a 1% rise in interest rates from a 1% base yield is a much more substantial rise than 1% on a 3% base yield. So in that sense, we are all bond investors now. And this demands we pay close attention to the outlook for global interest rates and in particular inflation. At some point as COVID passes, we will look toward to normalizing, that is, rising interest rates. At first, those will be good news rate hikes as economies recover. But there is prospect for forward-looking inflation forecasts to start rising and thus force the hand of central banks on rates. For a start, there are some very large stimulus packages around the world for pump priming, and there's plenty of capital sloshing around the world, which we already see causing asset price inflation. COVID has simultaneously created pent-up demand for goods, weakened the efficiency of supply chains, and also shaken out weak competitors across various industries, all of which open the field for price increases by the remaining competitors. Commodity prices have recovered from the COVID-related collapse with signs of more price rises in core commodities such as iron, copper, oil, and food supplies. Now, the Biden administration is about to throw another $1.9 trillion into the U.S. economy, while the rollout of mass vaccinations may be largely complete in the next 6 to 9 months, opening the door to normalized economic activity. And behind all of that, we can't forget the reimposition of trade tariffs over the past 3 years, which ultimately is an inflationary force. Tariffs increase prices to consumers. In sum, it's evident that we need to keep a close eye on the global recovery, the prospects for inflation, and global interest rates, as that's driving all asset markets. In any case, betting on volatility seems like quite a good idea for the current year. Thank you for the opportunity to offer some reflections and thoughts.